Hi, everyone. Welcome to the first episode of Accelerating Lower Middle Market Value, sponsored by Brady CFO. Accelerating Lower Middle Market Value. There's a lot to that name, and we are definitely going to cover off on it. I'm going to cover 4 major points of what that name means. What exactly is the lower middle market? How do you define the value of a business in the lower middle market? Why is that important to you as a business owner of a business in a lower middle market? And how can you accelerate your business value? So first, let's start off. What is the lower middle market? Well, I think it's best to start off with a spectrum of businesses that you can have publicly traded businesses that do tens, if not hundreds of billions of dollars of revenue a year. Think Google, Apple, etc. They're publicly traded on public stock exchanges. Then on the other far end of that spectrum is your neighbor that runs a local boutique on Main Street. Those are 2 very different types of businesses. But even amongst all of that is something in the middle called the middle market. The middle market generally comprises businesses between 5 million in revenue all the way up to tens, if not hundreds of billion dollars in revenue. The big difference between businesses in the upper middle market of that range versus publicly traded companies is their ownership. Middle market companies are privately held versus publicly traded companies are listed on a public stock exchange. So the middle market are privately held, privately owned businesses that are slightly bigger than small businesses. So again, they usually start at about 5 million in revenue. That even in itself is a huge spectrum of businesses. We know that a business that is operating with 5 million in revenue versus a business operating with 50 billion in revenue are 2 very different businesses. So even the middle market has to be broken up into segments. And this podcast especially focuses on the lower middle market. And the general definition of the lower middle market are businesses with 5 to 50 million in annual revenues. Now, I agree with probably some of you that are thinking, there's businesses that what makes them be in the lower middle market just because they have 5 million in sales? That feels a little bit arbitrary that, some businesses can earn 5 million in sales a lot easier, but look a lot different than businesses that have less than those amount of sales, etc. I totally agree that, there can be a construction business, a general contracting business that does $5 million in revenue in their first year because they got one big job and the owner is operating as a project manager and doing all the work and hiring a bunch of subcontractors and has their mom or their spouse doing the bookkeeping, and it's a very small business and they're doing 5 million in their first year. Versus you can have a professional services firm that does $4 million in revenue per year, so it isn't quite at that 5 million threshold, that can have 40 employees, that the owner is operating as CEO and ultimately operates like a very legitimate professionalized business and has been in business for several years. Those are 2 very different businesses in themselves as well. So while a business range of 5 to 50 million in annual revenues is a general range of definition for lower middle market, I think it's important to rather define the qualitative characteristics of what makes a business go from being a small business, a small enterprise, to being a business in the lower middle market. And the 2 major characteristics are, in my personal opinion, are your team. Do you have a team that operates with you and that is keeping you out of the day-to-day functions of every aspect of your business? So think about this. If you're running a local boutique on Main Street, you're the one opening the shop doors every day. You're the one handling payroll, doing payroll yourself. You're the one that could be doing your own bookkeeping or working very closely with your bookkeeper. You're the one helping to, provide oversight to your marketing team doing social media, or you could be doing it yourself. You're the one interacting with the customers on a day-to-day basis. You're doing everything as the owner. While a business in the lower middle market, generally the owner is not doing everything, that they at least have some team members that they've begun to delegate to that have responsibility over functional areas of the business. And so a business in the lower middle market, they have a team. That is not to say that the the team itself can't be improved upon, and that there still may be areas that the business owner can still delegate and improve upon in their delegation and removing themselves from day-to-day operations. But there is the formation or the beginning of a team. The second qualitative characteristic of a business in the lower middle market is the fact that they have systems and processes, or at least the beginning formations of some of those. And so with a local boutique on Main Street, as an example, the owner may just do everything. And oftentimes business owners and businesses that size, they are literally wearing different hats throughout a single day. And they're just focusing on maximizing customer service, and they will go to any degree to just make sure that their customers are happy so that they get that next sale. And so if that means they're working 12 to 14-hour days to go a little bit over, above and beyond, and to do a little bit extra for the customer, they're going to do it. But there's not very, highly defined systems and processes for what your sales process look like, what does your operations, and service delivery look like, et cetera, of how team members can operate. And so those things don't necessarily exist. And it's really just a matter of, there can even be a small team in a small business that is in lower middle market. There can be a small team, but everybody is just, really trying to keep, the wheels on the bus, and is just trying to make sure that there's high levels of customer satisfaction in every engagement that they do. Those are the two big qualitative differences. And so that is what defines the lower middle market. So the second point I want to cover is, how do we define value in the lower middle market, specifically the business value in the lower middle market? And it is comprised of two major concepts: cash flow and risk to cash flows. Does your business is valuable and is even more valuable if it has high quality cash flows and very predictable cash flows, and there is very little risk to the continuation of those cash flows. That is what defines value and what ultimately you want to focus on in order to increase value. We'll expand upon accelerating increasing value a little bit more later. Now, I want to make sure we understand, why is this important to our audience that we've talked about? What is the lower middle market? What is business value? Why is this important? Well, it's important because business owners have a lot of their wealth tied up in the business, and that can be very risky. As a business owner in the lower middle market, you have gone through the trenches. You have put a lot of sweat equity in the business. You have probably not fully funded your 401k. You do not have some grand, retirement fund, because you've put a lot of, spare financial resources back into the business to help fund the business and to keep its operations alive. So a lot of your net worth is tied up in the value of the business. What if something were to happen to you? It's actually said that the majority of businesses exit or transition / sell as a result of death, divorce, disability. So think about it. Say you're 40 years old, you have a couple kids that are entering high school, and you become disabled and can't continue as CEO of that business. You really can't continue working. What happens? How do you financially provide for your family going forward when you could potentially have a lot of life ahead of you? This is why it's important to consider the value of your business. The other reason is not just for, potential unplanned events, but for future planning as well. That, again, you do have a lot of your net worth tied up in the business. And I'm sure that none of us have started businesses with the intent that we never want to take a vacation and we never want to retire someday. That I'm sure that, and it's a perfectly fine idea, that you could want a house at the beach. You could want to retire and do different things with your life beyond your business. Well, how do you financially provide for that if so much of the value of your net worth is tied up in the value of your business? Well, you need to understand the value of your business, and how do you accelerate that value, or how do you increase that value so that you have a greater likelihood of meeting your financial objectives in the future, and how you want to retire, or how you want to do anything. That there could be things that you want to do for your family that ultimately the value of your business is going to help determine whether you can actually do those things or not. So it is incredibly important to understand the value of your business and just general good practices, the concepts of how to increase the value of your business, make your business less dependent upon you and free you up to enjoy your business even more. And so we don't always have to consider exiting a business, whether through a planned or unplanned event. Value acceleration or value maximization business, the concepts that align towards value acceleration or maximization also just help you enjoy your business, that it enables you to have a business that ultimately runs without you. And so you can go take a month vacation to Europe or wherever you want to go on a missions trip with your church or whatever that may be, and your business will still run and you still have an income stream and you still have a non-risky income stream that you can rely upon and that can financially provide for your family and for the other ventures that you want to do with your life. So it's incredibly important to consider your business's value and how do you increase that value. So how do we accelerate business value? We talked about that business value is made up of two concepts: your cash flows and the risks of those cash flows. You want to increase the cash flows and you want to decrease the risk. So how do you increase cash flows? Well, you have to increase the margin in your business. And one of the big proxies of cash flow in a lower middle market company is EBITDA, earnings before interest, taxes, depreciation, amortization. Increase your EBITDA, ultimately increase the value of your business. There's different ways that you go do this. You could have too many costs in your business. And so sustainably, you need to reduce costs in order to improve your EBITDA margins. Not a lot of businesses, though, I would say, are, suffering from too many costs in their business that they have to extract. It's more so that, a way to accelerate business value is to actually improve your sales while maintaining your cost margins or improving your cost margins. And so ultimately, your bottom line, your EBITDA, is gradually improving over time as a result of selling more and keeping your cost margins either relative to where they're at today or improving them, so that ultimately you're just accelerating the total value of EBITDA that your business produces. That is one way that you can ultimately increase the value of your business. The other aspect is you want to decrease the risk to continuously producing that EBITDA going forward. What do I mean by that? Well, the best way that I can describe this is, this is comparative to the valuation of a home, for example. You can look at two homes in a similar neighborhood. One's a new build, same square footage, as another home that is a 30-year-old home, same square footage. The 30-year-old home is going to be valued less. And why? It's because of the perception of risk that there is going to be additional maintenance and additional cash flows that will be required from you as the owner of the home in order to continue to live in it, to operate it, etc. So therefore, you will pay less for a home that has the same square footage, same lot, etc., in the same neighborhood, same school district, that is 30 years old than you would for a brand new home, a good quality built brand new home, because of risk, of the fact that it will take additional investment for you to continue to maintain and operate the home. That is what a business buyer will look at your business, is if you as the owner exit, what is the risk of continuously earning that EBITDA? Because if they are coming in and they're investing equity and they're bringing in outside debt, well, say if they're bringing in outside debt, they need to make debt payments. So they need to have continuous cash flows to make those debt payments. They want to make sure that they can continuously make those debt payments without having to bring in additional outside investment. They need to make sure that there's continuity of cash flows. And so it comes back to some of the original concepts that we talked about. The way that you decrease the risk of business continuity and continuity of the cash flows is that you have a really outstanding team that makes it so that the business is less reliant upon the owner themselves, and you have systems and processes that do the same. So the idea is that when that business owner can go take a month-long vacation and that business continues to operate and meets all of its goals for the quarter, because there's an existing team that continues that business without the owner having to be present every day in the office, you have a very marketable, sellable, higher value business at that point. And so, yeah, just to reiterate, de-risking your business means that your business can continue to operate without you, and that there is a high quality team, there are high quality systems and procedures, there is diversification in terms of your revenue streams and your suppliers, et cetera. It is really about de-risking any idea that your business will not continue in the future and produce quality cash flows that you've earned in the past, and that you forecast in the future. So we have covered what is the lower middle market, how do you define business value, why is this important to you, our audience, and how do you accelerate business value. So who am I to talk about this? Well, I'm your host, Mason Brady. I run a CFO advisory firm called Brady CFO, and we specifically focus on serving clients in the lower middle market. We have served tens of clients in the lower middle market and are helping them grow to actually grow out of the lower middle market. But we are serving those clients with top-notch financial and strategic advisory, making sure that they have enough cash to grow and ultimately implementing plans for their growth, and so that they can maximize their business value, and they are de-risking their businesses and ultimately also helping them grow out of lower middle market value and thereby increasing value overall. So this is what we focus on day to day in our service offering to our clients. But even before that, as a corporate CFO, I helped businesses in the lower middle market. I helped businesses accelerate past the lower middle market, but definitely had a core focus of working with groups of companies in the lower middle market. And so just a lot of breadth of experience. And I think this is personally an underserved market that a lot of business owners need help as to how do they get to the next stage in their business. I'm sure that business owners in the lower middle market can attest that the business that they were at $1 million in sales versus them being at 20 million sales, they are a very different business, and the owner themselves are a very different business leader. And you will constantly have to evolve both as a business and a leader to help your business get to the next steps. But I definitely feel like there is a lack in the marketplace of advice and guidance for businesses between that 5 to 50 million revenue range of how do they accelerate and how do they grow their business to eventually catapult and where they can have a full-fledged leadership team, and the business owner can begin to take the vacations and begin to really enjoy the fruits of their business and maximizing their value and making sure that there's good plans in place. And so I have a personal passion for wanting to serve business owners in the lower middle market, and it's what I specialize in. It's what our team at Brady CFO specializes in. And so we really felt like there was this grand opportunity to interview people that are business owners in the lower middle market to get their advice on how they've gotten to where they are today and what they're thinking about in regards to growth and how they're accelerating their growth. And so we're interviewing them to get their best insights to share with our audience, that things that our audience may be wondering about, that, hey, how should I consider this in regards to my revenue diversification? How should I consider this in regards to building out my team to accelerate my business value and to accelerate my growth? And so we're interviewing business owners that are going to share their insights to their growth and how they've gotten to where they are at today. In addition, we are going to interview service providers that serve the lower middle market, that are focused on helping business owners increase their cash flows and de-risk their business. And so these service providers will provide their best insights for business owners as well in regards to how business owners can grow their business, can de-risk it, and accelerate their value. We are so excited for what we're going to do with this podcast and for the people that we're going to interview and the value that we hope it brings to you. So we are incredibly excited. Thank you so much for listening to this first episode. Thank you so much for allowing me to expand upon what does it really mean to accelerate lower middle market value. And if you'd like to learn more about our sponsor, Brady CFO, reach out to bradycfo.com, and we'd be happy to be in touch with you to have you learn more about what we do. But ultimately, we are here to serve you, the business owners in the lower middle market, and help you discover how you can create the business of your dreams and not run out of cash, and make sure that you are funding your personal lifestyle, that you have a good plan for what the future is, and that we are just so excited to be able to interview people and to serve you. And so we hope this podcast is of value to you. Thank you. Appreciate it. Well, thank you everybody for listening to this most recent episode of Accelerating Lower Middle Market Value. We hope that you found actionable insights that you can implement today to accelerate your business value. Wanted to give a shout out to our sponsor, Brady CFO. Brady CFO is a team of CFO advisors that help business owners in the lower middle market build the business of their dreams via comprehensive growth strategies and financing that growth. If you'd like to learn more about Brady CFO advisory services, visit bradycfo.com. Thanks everybody. Until next time.